Hi, this is Skyler with Regan Capital. Today, we'll give you a quick update on where rates stand and taking advantage of the curve and investing in the front end of the curve, especially in floaters. So, I have up on my screen here the curve from the day before the Fed cut interest rates, which was last September, roughly 9 months ago. You had a steeply inverted curve. You were getting about 5% on the front end, only about 350 in the belly. But fast forward to today, the curve is still inverted. You're still not getting paid as much as you are on the front end that you are in the quote unquote belly, call it the 2 to 7 year part of the curve. In order to get that 4.3, 4.4% yield, you have to go out to roughly 9 to 10 years out the curve to get the same as what you would get on cash. And we're seeing a little bit of an anomaly here where you're actually getting about 4.4, a little bit higher due to the debt ceiling potentially coming up here in August, September. So a little bit of an interesting note there. So let's talk about options that investors might have above and beyond just owning a money market fund or treasury bills. Okay. If I went out and I bought treasury bills today, I could get 420 up to about 4.4% on owning bills. If you own a money market fund, a lot of money market funds are still charging between 10 and 20 basis points. So you're going to get about a 15 basis point fee to go out and have a fund that is deploying money in this part of the cash flow or this part of the stack. You can go out and buy those yourself. You can Fidelity, Schwab. You can actually participate in auctions as an individual if you want. But if you're an institution, you can very easily go buy these individual CUSIPs that would allow you to not have to pay fees. One thing that I've talked about that I really like are called floating rate notes, FRNs. The Treasury issues these once per quarter. I have up here the this is treasurydirect.gov. This allows you to potentially participate in auctions, but this handy FRN daily indices, it tells you exactly the spread that these were issued at over 13-week treasuries. So these are cool. They reset once per week. Your coupon resets weekly, actually. But they are based off of the 13-week treasury bill. And if you buy one of these, they're around for 2 years. You don't actually have to reinvest. It just continues to roll over the course of 2 years. And you can see the latest one here was dated April 30th, about 6 weeks ago. You were getting about 16 basis points over treasuries. So let's look at the performance of that relative to T-bills. So here I use T-Flow. T-Flow is an ETF. You could do this individually and not pay the fees. T-Flow charges about 15 basis points. And you can see that reflected here. I took the 5-year T-Flow versus the Bloomberg Treasury Floating Rate Index, 15 basis point differential. Orange line here is the index. White line is T-Flow. But you could see here, both T-Flow and SGov are managed by iShares. And so you have a floating rate fund and a 0 to 3 month T-bill fixed rate fund. And you can see the floating rate fund's beating the fixed rate fund by about 8 basis points annualized. Not bad. Now let's look at corporates. So if you take the iShares investment grade corporate fund, LQD, versus its index, you're underperforming the index over the last 5 years by about 20 basis points a year. But if you were to invest in floating rate investment grade paper over the last 5 years, you would actually kick off an additional 23 plus percent. You'd beat the fixed rate index by 22. You'd beat the fixed rate ETF by roughly 23 percentage points, roughly about 3.5% annualized, 4.5% annualized, 3.5% positive annualized versus negative 90 basis points negative annualized on LQD. So let's put that into perspective as we look at a agency mortgage-backed floating rate bond. So this is a bond that the underlying loans are 62 months old. They're about 5 years old. They're paying about a 350 coupon. I'm going to run this at 7 CPR. That's 7% annualized prepayment rate. I am going to run it to spot rates and forward rates. And I'm going to run it at about 100 in spread. That's about where these things trade. So here, what does that mean? It means you get 100 spread over treasuries. If rates stay constant, that is C, you get a 5.37% yield, 100 basis points over where short-term treasuries are, short-term SOFR is. Um, to the forward curve, and again, if we go back to the curve, it's obviously downward sloping. Okay. So when you do run these assets, whether it be CLO, AAA floaters, bank loans, et cetera, when you run them to the forward curve and you have a curve that's shaped like this, your yield to forward will be lower than your yield to constant or yield to spot. Okay. Because rates are scheduled to come down. And we could see that here. You have about a 50 basis point differential between spot and forward. Kind of just reflects, hey, rates are going down by roughly 50 basis points. This bond's going to be around for about 5 years on average. Okay, you could see that here. Now, let's go back to September 17th to give you a better visualization of where yields to spot and yields to forward looked back then. As you can imagine, your yield to spot would have been really, really high, over 6%. But your yield to forward, since rates come down to 350, is probably only like 4%. Okay, 3.5 plus 50 basis points. Let's go back. September 17th. Voila. 611 yield to forward or yield to spot and 428 yield to forward. Okay, so way, way back then, only 9 months ago, your forward or yields to forward generally on floaters was not great. Okay, so many folks at that point in time were saying, hey, I don't want to own floaters because rates are going to come down so much. My yield to forwards isn't that great relative to being able to go out and buy fixed rate. But this shape of the curve, this inversion in the curve, floaters are extremely attractive because not only are you getting a superior position of the curve, you're buying the highest yielding part of the curve, you're buying a floater off of that. If this yield goes from here to here, or from here to here, as it's done, okay, and so let's fast forward to today, June 16th, this yield to forward went from 428 to 488. So your yield went up commensurate with the curve steepening out, yet your price hasn't really changed. You've been kicking off that superior cash flow, that superior carry. Your yield has gone up and your price has stayed the same. So when we're in a position of the curve like we are today, and the curve is inverted, floaters are the place to be. You're at the highest yielding part of the curve. You will benefit from a steepening, whether that comes from a bull steepening, the front end coming down, or a bear steepening, the back end coming up. You're going to benefit and you're going to sit tight in a very low vol security while you wait for the curve to get more interesting and for you to go out the curve. Thank you.